Jerome Powell is not happy about this. In fact, what we're seeing today is the worst possible circumstance when it comes to inflation and when it comes to interest rates. You came here for the truth, so let me unveil that for you in today's video. I'm going to break down exactly what's going on and then show you what this means to you, because seeing some statistics just doesn't really matter if you don't know how that relates to you as an individual. So we're going to break that all down right here. I'm not going to get into the jargon. I'm going to get into what it means for you. Okay, that's the important part. GDP growth slowed to a 1.6% rate in the first quarter, well below expectations. That's economic growth. That's the economy. And of course, if they're not getting the growth that they intended, where does this leave us? Where does it leave us after you've printed trillions of dollars? You've pumped it in and you've devalued that currency so much, and all you can get is 1.6%, and it's so manipulated to begin with, you've got a problem. The expectation was 2.4%, and they didn't hit that. And of course, as a result, the markets went down. Now, we'll see how long that lasts, because the markets are really high on that hopium. The Personal Consumption Expenditures Price Index, that's a key inflation variable for the Fed, rose at a 3.4% annualized pace. That's the biggest gain in a year. What does that mean? That's the PCE index. And what do we have? Well, basically, that's the way that they measure inflation. So they're measuring inflation at 3.4%, which we know, you and I know, it's much higher. But we're looking at their metric, and it's at the fastest pace right now in a year. So according to them, according to the Fed, inflation is increasing. So of course, that's a concern for Powell, for the FOMC, for the Federal Reserve, who were all just a couple months ago, we're talking about cuts. Every cuts. Every article was talking about cuts. All of the fund managers were talking about cuts. Every website was talking about this, and the stock market went up as a result. There was a grand disparity, my Finance Friday crew, you know what we're talking about here, between the stock market and the reserves. And I said, something's got to give. Either reserves will increase tremendously, or the stock market, it's going to struggle to go much higher at this point. It doesn't necessarily crash. But these two, the reserves and the stock market, they can't get out of whack. If you are confused with what I'm talking about here, just search the money GPS money mirror method, and you'll find the video about that. But basically what I'm saying here is that these things got out of whack, and now we have a reason for it to come back down to reality. It shouldn't be a surprise to anyone. Consumer spending increased 2.5%. So initially you might say, okay, there's an increase there. People are still spending more, but that's down from 3.3% in the fourth quarter, and it's below Wall Street's estimate of 3%. At the same time, on top of that, we're talking about inflation that has gone up considerably. So it's not as if people are buying like all the cool new stuff. It's just stuff is more expensive. And even in that way, people are they're holding back on purchases. You've seen it. I've seen it. You've been talking to people. I talk to people everywhere about cost. And like literally all over the world. I talk to people about this. I go into stores. I start talking to the people about it. Individuals, business owners, everyone that I can. I ask them about this. I want to know that information directly from you, from those people, right? I don't just see it in the stats. I'm showing you these stats, but really this is just the prop, because I've been talking to so many people for all these years, and I've been adding that to my internal database. Okay, so just make sure that when you watch these videos, you realize this is really just one piece of the total, information that I bring to you. Okay. This is just showing us that the data may not be as bad as it looks. A surge in portfolio management costs, which go up with the S&P 500, accounted for the full upside surprise in core inflation. That's something I wanted to note here, because you're going to see that stuff getting pushed out all over the place. But I wanted to make it clear. Okay, when we talk about that, that's still inflation. It's still considered to be part of the index. They're still going to be looking at that, but let's know the context of it. So that I show you that here. Of course, the average, website, YouTube or whatever, they're not going to tell you that. I want to make sure that you have the truth, not just what gives you the clicks and all that BS. US yields soar as traders see the Fed delaying the first cut to December. And now we're not even talking about June and July anymore. We're talking about December? Uh-oh. So what's going to happen here? Oh, well, that becomes the issue. Because if they're not going to cut until December, that means that rates have to stay at this level for this period of time. Uh-oh. At the same time, China's pile of treasuries also fell in February to $775 billion. This is a monthly decline of $22 billion. And they are still the number two, right? Japan number one, China number two. But they have been slowly but surely selling off their treasuries since I think 2013, but then it went down, then it went up and all that. But just if you zoom out and you look at this for over a decade, they were peaked out at like 1.3, 1.4, and then it starts coming down and down and down. And so we know that they are less likely to hold US debt and more likely to hold gold. So that shows us like, how can the US keep up what it's doing if China is not going to be that biggest buyer? They have to have other countries buying it up. And certainly that is happening. Other countries want US debt, but it needs to come with an attractive interest rate associated with it. The higher that rate is, the more difficult it is for the US to pay it back. So you got to watch out what happens with these rates. Hey, it keeps the dollar strong. So for somebody, okay, making US dollar, living outside of the US, that's very good. But at the same time, it's a fluctuating thing, because eventually that makes its way. Like a strong dollar hurts Canada. It hurts other countries as a result, because everything is priced in US dollars. So of course that's a concern. You can see this here. Thursday's report suggests inflation using the Fed's preferred gauge was likely firmer than expected. That gives investors another reason to give up on the idea that the Fed could begin slashing interest rates in the coming months. Typically, an underwhelming growth figure would boost hopes that the Fed will lower interest rates, but continued price pressures complicated that outlook. And so you'll see that on the chart right here. GDP change from the previous quarter, and very weak overall. The last time we saw it this week, it was 2022. Okay, so that's not a good sign, considering they've been pushing so hard, pumping all that cash in. It's not just the United States. You could see Canada's inflation rate ticks up to 2.9% in March amid higher gas prices, boosting June rate cut bets. Well, you'll see, looking at this, we don't know. We don't know what's going to happen, but they certainly want to pursue a higher level of interest rate. They don't want to do it too much to actually resolve the issue. They want to stretch it out. They want to prolong it. If they wanted to, Canada, US, anywhere else, to actually fix the problem, you have to create a period of deflation. You have to increase interest rates dramatically. Yes, that hurts the economy short term, but guess what? Everything's fine thereafter, or at least it's better off thereafter. The longer you stretch it on for, come on. You're not getting anywhere long term by doing that. But that's the way, your political class likes to do things. And of course, this way, you can always take more from the middle class, right? That's the point. You want to take from the middle class, because you have to make sure that the maximum amount of people are subservient. Stripe co-founder says that high interest rates flushed out Silicon Valley's wackiest ideas. And so he said, broadly speaking, the effects of the higher rates have been quite good, in Silicon Valley anyway. So they're not necessarily worried about the higher interest rates, and saying, yeah, when you had zero interest rates, that's crazy. That creates malinvestment. And that is something that doesn't benefit everybody as a whole. Remember the NFTs, not just the NFTs that they exist. And if the fact that they exist is good, sure, great. But when they were saying that, you want to have that house beside Snoop Dogg, I remember the articles written about it. You want the house beside Snoop Dogg in the digital world because this is the fantastic thing. You don't have a choice to get that in the real world. No, you can get it in the digital world. And now you have that. It's so fantastic. It's amazing. All these celebrities were buying pictures of monkeys and stuff and saying that this is going to be worth way more down the road. This is just completely out of this world. That's 0% interest rates. This is the growth that we are seeing. G7 and the BRICS. Obviously, when you look at it, I mean, you can see where the growth is. Okay, it's in the BRICS nations. However, just keep in mind that, of course, developed economies don't have the growth of developing economies, emerging economies. That's obvious. Okay, we know that. They also generally have lower inflation rates. So keep that in mind, but we know where the growth is going to come from. That's what you got to understand here. Like, if you're expecting dramatic growth coming out of Europe, you're not going to find it. You're not going to find it there. So there's like the wheels are turning slower. So when you're investing, just keep that in mind and understand where things are. There's a much slower trend inside of the West. And of course, the emerging economies are going to see that growth. They are going to be the ones that do a lot of the consumption, right? They're going to be consuming more energy, things like oil. They're going to be doing things more often. They have to build more. And so as a result, there's going to be more investment happening there, more opportunities happening there. Doesn't mean that there's nothing happening in other countries, but you got to understand the way that is, okay? So I'm just trying to bring you a very level-headed explanation of what's happening today inside the economy. It's looking like the potential for no rate cuts. Could that be it? Because just a few months ago, everybody was talking cuts, and now suddenly a big change. All right. If you want to know more information about the financial system, you're like, what's this guy talking about? I have a free 100% free financial education course that doesn't even require your email. Not even your email. You go on there. It's called Compass, themoneygps.com/compass. And when you get to the Compass page, you just watch the videos and that's it. There's no sign up. There's no paywall, nothing like that. themoneygps.com. You just click on that Compass button and don't forget to hit that thumbs up button here to support the channel. That's what I ask of you. Just simply a thumbs up. I want to say thank you for being here today and I'll see you tomorrow. Take care.